Europe is the latest place to succumb to higher interest rates, with the European Central Bank overnight raising its cash rate by 0.5%. Let's go to Ross Greenwood, our business editor. Ross, remind me, weren't European interest rates negative at one stage?
Negative for some stage, Pete. They were negative for a long, long time. In fact, we can show you a chart just to give you some indication of what the European Central Bank has done overnight. Go back to 2013, and that's the first time when interest rates went to zero. Then 2014-15, you can see there that they went below zero into negatives. Well, that ended last night when the European Central Bank raised interest rates by a surprise 0.5%. It was expected to raise rates by 0.25%, but in fact, this increase is in response to inflation. It's creeping out in Europe as it is in other parts of the world and Australia as well. And so they've taken that cash rate, their basic rate, back to zero. Now, that's a far cry from, as you can see, where they had been previously. You can also see the recessions here in Europe, the most latest of which has been the pandemic recession. But the grave fear right now is that there is another recession on the way. That's the reason why the European Central Bank acted overnight. Here's Christine Lagarde, who is the head of that European Central Bank.
Today, in line with our strong commitment to our price stability mandate, the Governing Council took further key steps to make sure that inflation returns to our 2% target over the medium term. We decided to raise the 3 key ECB interest rates by 50 basis points.
So, Ross, does this give us any clue about the pressure on the Reserve to keep raising interest rates here?
It sure does, absolutely, because we know there is pressure on the Reserve Bank to raise interest rates here. Some are suggesting 0.5% in each month, almost out until the end of this year. But even the money markets themselves give us a big clue as to where they will. Now, at the end of trading yesterday, money markets were effectively saying, and you can see it here, that the cash rate, currently 1.35%, is going to rise to around 3.75% by the time it gets to the top. So give you a small indication of that. If you're currently paying, 3.5% on a mortgage, that's implying you're going to get out to pay somewhere between 5.5% and 6% on that mortgage by the time that this is all over. But you can also see on this chart here that money markets expect by perhaps late next year, early the following year, that interest rates will start to ease off. And that's in response to basically cooling economies both here and overseas. Of course, the Governor of the Reserve Bank here in Australia, Philip Lowe, earlier this week had also indicated that interest rate rises are on the way. It would be fair to say that most economists don't believe they'll go as high as those money market interest rates believe, but it would also be right to say that money markets have generally been more accurate in their forecasts over the past couple of years than what many economists have been as well, including the Reserve Bank.
All right, but doesn't all this risk recession? After all, Europe is already being knocked around by the shortage of gas from Russia.
100% it does, and that's the real problem here, and that is if the interest rate settings are wrong, it could risk recession. Now, the problem of recession is if unemployment rates rise. Around the world right now, just as in Australia, there's shortages of labour, there's shortages of skills, and so that's the one thing that are keeping these economies, including Australia, very much afloat. People have got jobs, and so they've got incomes, they can pay their mortgages, so things keep going reasonably well. But if these interest rate rises keep coming, and there's evidence of this in particular New Zealand house prices, which are falling rapidly at the moment as a result of its rising interest rates. And if that takes place in other parts of the world, that also risks rising unemployment. So let's go back here to Christine Lagarde.
The most precious good that we can deliver and that we have to deliver is price stability. So we have to bring inflation down to 2% in the medium term. That is the imperative under the treaty. That is the strategy review objective that we have set for ourselves, and it's time to deliver.
For the markets, Ross, they've had a great run in the past few days. What's that all about?
Well, partly it's about Tesla, I've got to say. So yesterday, Tesla, the most valuable car maker in the world, came out with a profit result, which, though down, was certainly better than the markets had expected. So here's the Tesla shares from last night, up almost 10%. You can see there, $815.12. Elon Musk also sold off some 3/4 of its holdings of Bitcoin at the same time. It seems as though they're trying to raise up a little bit of cash. And so even the Dow Jones index of US shares overnight has been much, much stronger off the back of this. And you can see here is the Dow Jones as it finished up by 0.5% today, 162 points. And that means really our markets here are going to have a pretty good day today to finish up the week, notwithstanding the fact that the United States Federal Reserve is expected to raise its official interest rates by 0.75% when it meets and hands down its decision next week.
OK, Ross Greenwood, thank you.